Estate Connections virtual meetup, and I should probably have that background here, right? My fancy Real Estate Connections got the logo there. Okay, so here we're trying to get together every week and make this a formal meetup online. We see over here in the chat box, we have people from all over the country: Baltimore, Orlando, Arizona, New York, California, Florida, Sarasota, Connecticut, Denver, Colorado, all over the place. Jerome out from Greensboro, North Carolina, Lakewood, people from all over the country. So the idea here is to bring people who are actively involved in real estate in some way or another, whether it's on the investing side, et cetera, and just get together and kind of meet, share ideas. We're going to bring in a guest speaker every single week. We have an amazing lineup already set up over the next 8 weeks. If everyone would just mute themselves at this time, when you come in, you're automatically muted, so that's easy. And then we are, like I said, amazing speakers. We have an incredible speaker tonight who I'm going to introduce in a moment. And then the next 8 weeks already I have lined up and, working on great speakers on different topics after that. So we got a topic, Neil Bawa going to come and speak about, market, how to find markets. We got next week a couple of multifamily guys going to be talking about, how to get through in the current situation, finding deals. A lot of different stuff. We're going to talk about self-storage. We're going to have someone come on and talk about gas stations and laundromats, a lot of different topics. So really anything and everything under the sun in real estate, just so we can all learn, educate ourselves, and of course network. So at the end of the call after the speaker, we're going to get together and do the breakout rooms, which everyone loves. And like we said, we can go on for a while. So without further ado, again, Yona Weiss, you may know me for cost segregation. That is the specs. That's what we do full time. But when we're not doing that, trying to get involved in real estate investing and networking. So I'm glad you guys all joined me here. And without further ado, I'd love to introduce Ira Zlotowicz, who Ira is the president of Eastern Union. Okay, Eastern Union happens to be one of the second largest privately owned brokerage, mortgage brokerage in the country. And I'm going to have to find his bio because I misplaced it for a second. There we go. But Ira is an incredible person in the industry. If you don't know him yet, you should, and I hope everyone get a little chance to get to know him a little bit tonight, because he's been in the mortgage industry for close to 20 years, over 20 years, and he's really made a tremendous splash in the entire industry, coming from basically nothing and starting his own brokerage, Eastern Union, in 2001, and then to today they're closing $5 billion in loans a year over the past couple of years. So they're growing. So I think without further ado, let's introduce Ira Zlotowicz, who is going to be speaking again about some of the things, the changes in the commercial mortgage financing. And Ira, maybe just give a little background in what you do before we get into the actual details, what you guys do, what your focus is in Eastern Union, and a little more that I didn't cover.
First of all, thank you very much, Yana. I appreciate you putting this together. It's it's an amazing, diverse crowd all over the country, like you started reading out as people are signing in. So just as a little bit of a way of a background, I like to consider myself a trusted advisor, as the market's going to keep changing. Financing needs are going to be different. Borrowers' needs are going to be different. We want to roll with the punches to be able to advise them and then be able to close based on the advice we're able to give. And sometimes if there's something better in an industry, we'll tell someone up front, hey, you're better off taking another product that's out there for you. And in many cases, even advising clients potentially to not even go pursue a deal they're working on. So I could have convinced them, could have gone forward, but sometimes not in their best interest. Obviously pre-COVID, majority of our business was probably debt and equity, full capital stack. So our average loan was probably about 60 to 70% was multifamily, and the other 30, 40% was mixed use and structured financing and some equity put inside there as well. So as a full firm over the years, many of my competitors over the years, when they look to expand to different services, they expand the services. Those similar services go into the brokerage field, buying and selling of real estate. That was one of the things we decided, let's try to align ourselves up with the relationships we deal with on a daily basis, what's in the client's best interest. Sometimes a conflict of interest. So we put all resources, the full capital stack. So we, instead of doing brokerage, we went out to equity. Equity is a license, you have to be licensed. It's one thing I could tell all of you on the phone, and many people think, oh, I'm buying a deal, my friend will give me some money, or I'll raise it and I'll get a commission. It's a securities issue. And my advice to all of you is that if you be raising money, make sure you're following securities laws. It's not a real estate. Don't ask your real estate attorney. You want a security attorney to get that working and figure it out. So as a firm, we stayed true to the core, what a client needs. We built divisions around all that, what a client needs. So we have an expertise in multifamily, conventional debt, bridge, structured, hard money, healthcare, and equity, and every property type under the sun. We basically do everything except for a 1 to 4 family home that's being used as a private residence. So anything that's an investor real estate all the way up, we're able to get that done. Obviously, coming into COVID required a lot of pivoting. And the main pivots that we worked on that will stay for the long term as a company is that number one is we're providing free underwriting. So somebody's buying a deal, looking at a deal, you don't have your staff. We thank God, and I truly feel blessed to be able to have done it till now. We just made decisions to put people over money, and we have not let anybody go. We haven't furloughed anybody. We haven't cut anybody's pay. And we keep attributing that as we roll out different things, as we do that, well, something like 2 days of those announcements, we're going to make it in a few more weeks, things keep falling into place. So the business is much slower, that's clearly, but starting to open up very little, but it's very slow. But we got involved in underwriting. People are starting to look at deals, and we're getting on a daily basis probably about 20 deals to put together on behalf of people throughout the country. Send an email to UW at Eastern Union. Within a day, they'll send it back. No questions asked, no strings attached, nothing. That's one. And the other thing is we're getting involved in note sales. The interesting thing on the note sales we're getting involved in is that we found that most people that are in the note business, we're trying to help the lenders and our borrowers. We found that most people that are in the note business, the brokers, that's just their business. They broker notes. But they don't have a real relationship with a lender throughout the year on the other side of the bank. So a lot of times the discussions with banks also need a trusted advisor. Should they sell at 80 cents on the dollar because it's about to go down to 70, or should they sell right now? So we're taking a stance on that side representing the lender's interest. So if someone's looking to take advantage of a lender, a lender, and try to convince the lender it's not worth as much, we're not getting involved. And I'm taking the lender's interest there on that front. And with the fiduciary responsibility really to try, someone told me once the dream in life is to be able to help people and make money. So I try to do different parts of my business where like I do mortgage, I help someone and I get paid for it. If I go into a situation if someone does have a problem at a bank, how could I work out a situation to help the owner, at the same time help the bank? And then, you get repaid over time, and not necessarily I could have made more money had I taken it, flipped it, run around, and go in that side of the business. So that was the big parts of the pivots. The real estate financing, I think really, I spend a lot of time analyzing and understanding and asking under the hoods of the why. Why are banks doing certain things? What's the reason? What do people believe about the market? And I think the updated consensus in the market is as follows, that everyone was nervous about rent collections for April, rent collections for May. And they're surprised that rents are in. But the truth is, in hindsight, the reason why they're surprised is really because the can was kicked down the driveway. The government came in and said, we are going to give you money, stimulus money. We are going to pay you that extra $600 a week when you're laid off. So really, almost every person that is laid off in America, the majority of renters in the country are better off or the same without a job than when they had a job. So they could have been earning $800 a week, and now they're getting $1,000 a week, them and their spouse. Plus, they got the stimulus check last month. So of course rents are good. The real now question is going to become, and I'm really nervous for it, is for August. Because come July, borrowers today, they're going to stop getting at the end of July that extra $600, the tenants. So if they stop getting it and they don't have a job, and they're coming back to the economy, what's going to be? So people could think that the government's going to make these more stimulus and do things. It's definitely true to it. They can do something. And leaving the politics aside, something will come about. They'll figure it out. The issue is, and I saw a fascinating video I posted about LinkedIn about why the government gave that extra $600. So the shock, people losing the job, they shouldn't be nervous, stay home. And also for social distancing, you don't have to look for another job, stay home. They did a quick thing. They made a few mistakes, but overall people have money. But that pressure, like when the PPP loans ran out, as a firm, we helped people over 10,000 PPP loans. And we look at that and say, these people that got these loans, again, it's only for the next 2 months. So people are staying home, and now they're going to start going out to work. But when the country is starting to open now, there's not going to be the same pressure to help the same way. See, then it was a crisis mode. You're terrible if you're not going to talk normally to your tenant. You're terrible if you're not going to work something out. The lender's not going to work something out with you. You're terrible, government, if you're not going to approve stimulus right now. But wait till the end of July. They're going to, this is the last thing for $3 trillion. They're not approving that fast. And as the country opens, there's less pressure. So they can go from 30 million jobs out of people work, 20 million, 10 million. It's not the same pressure. And that's why I think that August is really going to become the issue. Because even if the people still get extended, that's going to be the time when people are going to start having friends and family go back to work. They might not have a job, and then they can start getting nervous and pulling back on it. So I think August is really the turning point when we really have a better idea of what's going on. I think people ask me a lot of times, when do you think purchases are going to start? When do you think activity is going to start? Obviously, nobody could know. I can just give you insights because, I have the luxury to be able to speak to, the presidents of different corporations and entities and owners and banks and carrying, their consensus and their feedback. And just understand the problem why people are speculating. It boils down to the following. So no one's smarter than you. I can tell you the question you should focus on. Right now, the reason why there's very few new transactions going on is because the seller still thinks that it's going to snap back, a V recovery. And therefore, my $10 million building is worth $10 million. You want to buy it today? $10 million. You can buy it from me today. However, on the flip side of the coin, the buyer is saying, hey, it's not worth, look, everyone's looking for distressed debt. There's no way that we're going to have a situation where the building's still worth $10 million. I'll buy it for 8. I'll buy it for 8.5. So no one's coming back in that respect to buy now at that price. So therefore, what's going on the back and forth of the whole thing is that there's a divide. So right now, when will the seller and the buyer come closer together? The seller realizes, something, I'm not going back to those prices. The buyer's saying it's not coming down. So the beginning when that could possibly happen is probably going to be 2 months into, and by the time we get to August. So people could look back and say, hey, okay, April was this, May was this, June was this. The economy started to open. What's really taking place? A lot less speculation. Because on real estate, you don't make a lot of money on real estate. You're buying very low cap. You speak people, I'm going to take a risk now. I better earn. And then they have like crazy, different numbers or returns that they have to deal with under that sun. So because of that information, the consensus is that beginning the purchase should start is probably trickling in August. There are other people saying no. People are going to want to see a good 3 months under the belt of stabilization at some level before they want to speculate. So do you know the answer? We don't know the answer. Regarding Fannie Mae and Freddie Mac and the lending side of the equation, I think really under the hood, I think they came up, whoever thought of it, I think is sheer genius, how they did it with the reserves and the holdbacks that are doing it, because they basically, with this structure, are really protected no matter which way you think the market is going. Meaning, if you believe that values are staying the same, then they did a great deal. They did a loan. They're holding back at 6, 12, or 18 months of P&I and all that. And if the government, if the prices do drop a little bit, then they net funding, they're protected anyway because they have that difference in escrow at a certain point. So I think either way, they have the ability to ride it out a little bit to see what's going on. And again, the focus now really is it's a cash flow issue. Real estate when I came into this business in 97, real estate at the time was about bricks and mortar. When I used to discuss something about a deal, it was talk about, I saw the location of this property. You got to see the structure. I went to the basement, the boiler. This is a great building. The roof. Now it's all about financial engineering, the economics of the deal. So when it's all about the economics of the deal, it's all about the cash flow. Cash flows, collections. So everything is focused around where's unemployment, where collections are going to be, and how that's all going to go ahead and come together from there. So I think, like I was speaking to Yona a little bit before the call, I said everyone has different styles of what they like to benefit from some of these presentations, and I felt that the better way I spoke to Yona is that I'll give like a little bit of a background opening like I just did, and then from Yona's end of it, he'll go through some questions that either he had in like an interview type of process, and then if people could feel free to ask questions, then we'll take it from there, because I'd rather focus on such a diverse crowd, focus on questions that are important to the group that's here, as opposed to maybe what I had something to say, but it's not something of interest to anyone that's sitting here on the phone.
Okay, I appreciate that, Ira. Thank you for the introduction. And I do have a question. Actually, you kind of brushed over a lot of different things, and maybe just for the benefit of everyone here, you just touch on a couple of the points that you brushed over. And then I see a couple of people ask questions in the chat. And if anyone has questions, please put it there, and I'll read them. Or if you want to come yourself live and ask the question live, we can do that as well. But one question I have for you is, you mentioned that, what Freddie and Fannie did in terms of the reserves, right? Can you just touch on that briefly for someone who doesn't understand what that means, and what exactly Fannie and Freddie did with the changes in the lending since COVID?
Right. So basically, when many people think that banks take risks. Banks don't want to take any risk at all. When the bank makes a loan, it's a $10 million building. They want to be protected on two parts. They want to be protected on the loan to value. This deal's a $10 million deal. I'm willing to lend you 70, 75, 80% of that $10 million. Let's go with an 80%. They're willing to lend you $8 million. That's one part of it. The other part, which is much more prevalent today, that's what most banks focus on more, is the cash flow. I want to make sure that in addition, that you'll never have a problem paying me the mortgage. So they lend you enough money. And I updated recently one of the things, we spent a lot of money giving out, upgrading the Eastern Union app. It's a free app. We came out with an e-calculator there that will do underwriting. It could calculate under a few minutes. We calculate IRR, cash and cash, 10-year projections. So if you play with the numbers there, you'll see, and you can see by the calculator built in, that how much money you could borrow based on a debt service coverage ratio. So they have a buffer for themselves that, okay, based on your collections of $50,000 a month, based on the expenses and underwriting, you could borrow a loan of whatever the loan amount is at that time. Let's call it $8 million. But since the concern is that how do you know the tenants are going to pay the rent, you might not have this rent that we counted on. So to protect themselves, and every lender is pretty much doing this today, they take a certain number of months, they put away a certain number of months in escrow. And they say, okay, I'm going to give you a loan. Your payments every month were $10,000. I'm going to put away $120,000. Let's call it for a year in an escrow account. Every month, you don't use that money. Every month, you pay your regular payment. On a month that you have a problem, then you'll go back and you will, if you have a problem 1 month, you can pull it from the 120. The thought process is that this way, COVID will definitely be over in a year from now. They should have a vaccine, something. And at that point, everything should be fine. And if it is fine, at a certain trigger, you get back your money. But this way, they're protected, that the value is there, it's the new appraisal. And they think from cash flow they'll be fine because they did an interest reserve, a principal and interest reserve for that, sometimes 6 months, 12 months, 18 months. Sometimes you can negotiate at different lenders when you draw down the money, but that's the general idea.
Great. Okay, so basically there are reserves, and they're different based on the type of building and type of product that's out there. There's going to be different capital reserves that are going to be happening.
Yeah, but that's always going to be the case. I'm talking about specifically once they decide how much money they're lending you, and they come up with your monthly payments, they're going to want to make sure they have enough money to cover that in the event that some of your rent goes down. So there's two separate things. One is how much they're willing to lend you, and then of whatever they're lending you, make sure you have reserve money put away for that over time.
So someone is asking here in the chat, is this escrow mandatory now?
Yes.
Okay.
Someone wrote back, we expect the 12 to 18 month agency escrow to go away anytime soon. I think it's going to go away sometime. Obviously, ultimately, they feel comfortable that the number they're underwriting is correct. So that's going to come at a blend when they decide, like in a typical loan, all of you buy a building, you typically would underwrite a deal, take a 5% vacancy in collections. If people come up with a number, let's say, they might decide instead of doing that reserve, just underwrite a deal at 10% vacancy in collections, and then whatever it is, we're fine. It's going to either come something along those lines, or a few months in a row where they realize, something, everyone is staying at, this 90% range, 85% range, and they'll get comfortable. And if that's the case, they'll take, instead of 12 months, 6 months. So it's a blend that's just going to disappear or take less and less as time goes on.
Gotcha. Someone asked over here, Max asked, what's your biggest concern regarding the long-term economic impact of real estate and permanent changes?
So that's a little bit.
It's a very open-ended question.
Yes. So, in my opinion on this is that I think it's not real estate driven. I think this is all about can be unemployment. I think unemployment is going to be the driver for everything. So it's really, what do you think is going to happen to unemployment? Do you think that everyone's snapping back to work when this opens up? Or even if it does, people do come back. There's definitely changes that are permanent changes that will never change. So we never would have been on the Zoom call prior to this, and it never would have happened. But I could see even after COVID happens, people will go back and potentially continue this afterward. So you wouldn't just say, oh, networking means in person. There'll be hybrid type of situation, just like on the online retail in the stores. You have the store and you have the online. They work together. You place an order online, you go drive by and pick it up. So I think that there are fundamental changes of work from home. I was talking to a very big landlord today in New York City who was telling me that the problem they're having in New York City is that tenants, the same percent of tenants that normally leave a building are leaving. Whatever, every month they lose a fraction of 1%, a 1% turnover. But they're not getting any new tenants coming in. They're seeing their vacancy going up. Are people leaving the city? They don't know these things. So there's certain changes that are going to change that people might want to leave cities. There's certain changes regarding office space. It becomes the big debate. And an interesting thing, I was listening to a panel of someone from Goldman Sachs. They said two state lines that thought genius. They said one on retail. They said retail is like an old person that has underlying conditions that has 5 to 7 years to live. Along came COVID, gave it 3 months. So in the office, that was on the retail. On office, they said the way they see office, definitely more people are going to work from home, a hybrid. Now this is without technology working perfect and having your kids behind you. We figured it out. But they think what's going to happen on the office space is that the corporations are going to have their main corporate offices, Class A space in major cities. And then they're going to have the majority of their staff moved out to a city nearby, or once they're not in the same building, they'll go into a market where they could get quality workers at 20% cheaper than inside the city. So that's what's going to change in that marketplace. It's everyone's guess ultimately, but clearly I know for myself, and I speak to different people, different firms. Like one bank told me, they said, Ira, we became a digital bank overnight. So I can tell you clearly that when we come back, we're going to never miss a committee meeting because everyone could zoom in from wherever they are in the world. We're going to do DocuSigns, everything. We're going to, there's a bank I do business with based in Pennsylvania, and it's a regular typical bank. And I'm talking to them, so the market is changing. And I was telling me they just did the PPP loans now. That bank, they are based in Pennsylvania, a regular bank, no tech bank, a simple, normal, slow process bank. They did 77,000 loans. They said they just like partnered up with some fintech and all these things. And he goes, whoa, well, now we see this. And the board in that bank is over 60, everyone on the board. One person's in the 70s. They said, when we saw this, we have a whole different attitude to how we're going to go do business and streamline things. So I think the attitude adjustment combined with outsourcing and, hey, the person doesn't have to be in my office every day. It's fine if they came in twice a week. I think those things are going to be changes. Where's it going to go down to? Where's it going to trickle down to? I don't know the answer, but it allows people to have flexibility. Look, Yoni, where are you now? You're in Israel now?
Right now, yeah.
Yeah, so we're having this here. You're based in Israel. Someone's based there. It's all over the world, right? You couldn't come in once a week for a networking event. So that's the story. And
right,
all of us, if you did a traveling networking event, you only have 8 of us in each city. At most, 3 of us, 5 of us.
Exactly. So I totally agree with you. The benefit and hybrid and the changes that are happening are incredible, and I think you're right. A lot of things are gonna have changed are gonna stay the same in terms of the change. So I think that's a great point in terms of everyone, from the banks to the buyers. I mean, I think buyers are changing the way that they're underwriting deals. Obviously, they're changing the ways that they're looking for deals. Obviously, they can't travel the properties.
I'm not really sure if over COVID they're changing the way they're looking for deals. They're just adjusting the risk. Is the cap rate changing a little bit? I think it's the same fundamentals. Get to the NOI the same way, and then account for what if the collections come into an issue, and then what cap rate do you want to put for that risk.
Right. Yeah. Okay, a couple more questions here. Let's scroll back up here. We had a question. I saw one further up here. No. Okay, we got to that one. So what do we say? Do you see, Jorge asks from Texas, do you see bridge loan options coming back anytime soon with the types of terms we were seeing before COVID-19?
So I think there's a very good point to understand. Bridge loans were always a rate of 12%. I think if people understand this fundamental, then they can start answering a lot of the questions themselves. A bridge loan was always 12%. And again, part of things we built out on the calculator is like you could go to by the mortgage calculator part of the app, the eCalc, you could actually do a first and second mortgage and see blended rates. What's really happening is that someone who's taking the riskiest loan, they want 10, 12% on their money. Maybe they went down a little bit. But what's happening in the last market is they were leveraging up those lines. So when they came to you, made an $8 million loan to you, they wanted 12%. They found the bank to lend them $6 million behind the scenes at 6%. So it came out, they were able to make the 12 on the top, 6 at the bottom, and your rate worked out to 8% in total. Something along those lines. So I think what's the issue now is they've snapped back to the 12% instead of the 10. So they want a little bit more snap back, and they're having a tougher time leveraging such a high percent. So they used to get 75% of the loans leveraged. So they put up 2 million at the high rate, 6 million they got a low rate. Now they only get 5 million at a lower rate. That rate's a little bit higher, so the blends are up. So that money is available, but again, think about when you're a lender. A lender once told me, when on the rates on its way down one time, when 4% was considered a low rate. Remember, going back a few years ago, a lender tells me, IRA, we have a special, 4%. But here's the catch. I only want a deal that has 4% issues. If you have to ask me too many questions, I have to ask you a lot of questions about the deal, I don't want to do the deal. It's not my 4% deal. Right up the fairway. So in using that example, that's what's happening now, is that a lender, the guy tells me, Ira, let me tell you the story. If this guy does well, he's paying me off in a year from now. If he doesn't do well, I'm in foreclosure with him. So therefore, there's no way under the sun I'm willing to sit here with you and take a risk at any level on these loans. And once he came up with that and explained it to me, that same thing here. If a lender's making a loan today, if I own a deal, I'll take a little more risk. So the cap rate be 5, 5.5, 5.25, I can risk it. If I'm a lender, I don't want to take any risk. I'm not in the business of taking risk. I'm in the business of lending money and getting paid back.
Awesome. Okay. Another question over here from Vivek is, what kind of multifamily deals are you seeing these days? Loan assumptions, bridge. I think he's talking about in the current situation. I mean, obviously business is slow and everyone's seeing it slow, but the deals that are happening, and there are deals happening, what are those deals?
So I think that the majority of deals that are happening now, forget not that people are kicking tires with, right?
No.
But the majority of deals that are actually happening are really deals that went pre-COVID, either in contract pre-COVID or were close to going in contract, so they tweaked their price a little bit and they went into contract. That's one type of deal that was working. The second type of deal are refinances. And refinances, when someone had enough news, a refinance when someone had enough cash out there that they could justify taking the loan with a holdback, for this reserve holdback, and still work. So it was tougher. Now already, some people are getting an idea where their buildings are at, and they think it's going to stay. Like I said, I think the next shoe to drop or not drop will be August. And if August is fine, but there's a part of me just doesn't understand everything I was ever taught in my life, that how could you have 30 million people unemployed in the stock market where something doesn't add up? Unless someone's dreaming that everyone's coming back to work, companies aren't going to rehire just as fit. I don't understand it. So to me, that's one part that's not making that much sense. That's why I think that it's going to take longer than August for things to start. I spoke to a very large property owner, multifamily, I think it's like the number 2 or number 1 borrower at Fannie Mae. And he told me that he took all his properties that he planned on selling this year off the market until his first quarter of next year. He said the reason why I did it first quarter of next year is because obviously it's tough. People want a discount if they're buying while they're taking extra risk. But then it'll be calmer. But he said more importantly, in hindsight, 2020, when people wake up on January 1st, they look back at 2020. They look back at 2020, they're going to see that multifamily from any investment was the safest investment class, period. So stocks, bonds, different property types, every type of investment. And therefore, there's going to be a lot more money coming after multifamily. Someone else told me that if government's going to start giving rent checks, which I spoke to another owner that has this whole theory that the government's going to start giving rent checks, then it's going to start becoming a regulated type of business. But on the other hand, it's much more secure. You don't have to worry about your tenants paying you. And then real estate prices are going to go up for about a year or two because people are going to be willing to buy like a bond almost. So there's all different thoughts. But again, this is it's not like anyone here can make that difference. These are things people are talking about. How quick is the economy going to come back, and what is the government going to do during that time?
Someone here has a question about seller notes. I think Tony, you wanted to ask that verbally.
Is okay. Yeah, it's a little hard to type all of it. We do seller finance notes, and brokering also. So you mentioned seller finance notes. So our model is we'll find the simplest form, a homeowner. It could be an apartment owner, tired landlord, whatever. And they carried a note for a buyer. And so that investor says, I'm kind of done with the note. I want my money now. So we have investors on the other end that will strict preferred note criteria will buy those notes at a discount. So is that, when you said seller finance note, how do you view that? Well, I mean, what's your
No, so
What's your
I'm
motto on
looking
that?
at, on a note sale. I'm talking about a note sale. Just, I mean, it could be the same thing. They're typically conventional lenders, but the bridge lenders also. At one point in time, they want to. They have to liquidate, and based on the market today and the belief of the underlying asset and where the underlying asset is, well, they have to sell that note at a discount. So sometimes it comes in that someone buys it all cash. Sometimes it's bought out with the same like a mortgage. There are people who give a loan against that. So if there's a unpaid balance of UPB of 8 million and they buy that note for 7, a lender may lend 4.5 million. That person puts up 2.5 million, and then they would continue on and collect or go through the foreclosure and then take back the property.
So you're talking about, thank you. You're talking about bank selling notes. So yeah, excellent. Any other questions over here for Ira? I don't see anyone typing any questions. I'm gonna raise, if anyone wants to raise their hand and talk about anything happening in the market in terms of the lending practices going forward. Max asked the average time to fund a deal. So are we seeing differences in that
Yeah,
currently?
so we're seeing much quicker to do a deal from the past, because most, like, we all have time, right? So the lenders have time, and when the deal finally comes in, everyone just focuses on it and they get it through the pipeline pretty quick. Like, they're without any special systems, just get deals done in 30 days, 45 days. New Fannie deals, that's what they're really thinking about to process those levels, because it's a new process. Everything is here, and just move forward.
Right, there's less paper stacks
Huh?
sitting on people's. There's less paper stacks sitting on people's desks.
Yeah. So somebody asked about when they're modeling a deal, what loan to value should they go for? They should go for I think the same 75-80%. We're getting 80%. So you could underwrite a deal for 80, and I'm telling you, I think if I built it from someone that's entry level in the business all the way up to the top and down, and you'll find it that you don't have to know Excel, you don't have to have any special techniques. You download the Eastern Union app. You don't have to have a login. Soon we're building out functionality, be able to share the model with someone else. But you could just literally start by putting in the cap rate, putting in your purchase price, the income, or calculate the cap rate. By the mortgage, I'm getting 80%, and all the way down to figure out your NOI, your cash and cash, IRR, equity multiplier, what you split is going to be between you, the waterfall split. The beauty is, what I love it is, because most of us sit with a million what ifs. We have investors. If you guys are syndicators, there's a million what if. Okay, here's the calculator. Play with all the what ifs you want. And we even have examples that you do a 10-year projection there on the app. It automatically calculates rent growth of 3%. But in year 3, you think you have a rent drop. So just change it in there, and everything calculates automatically. What if I got a discounted price? What's better if I got a higher level mortgage at a low rate? But all those questions you just play with, and it's a lot. It takes under 4 minutes. So when we do the underwriting now, someone sends in UW to Eastern, they not only do they send back in Excel, they also run the model for you and tell you what the IRR works out to on the deal based on the standard assumption. They can go into the app and then change it accordingly from that point on. So it's the regular Eastern Union. You go to the App Store, it's Eastern Union. It's the same name of the company. And that's what it's all about. We're actually building, interesting, we'll have in the next few weeks for people on the go, is that when you send the underwriting in, you won't have to send it back to you. You could log into the app, will be there, buy your deal with the calculator and your document there. You could download your document off the app, and we're going to allow you, just finishing up the technology of it, to allow you to, if you have a document and you want to store it in that same area, so those that don't have a good system internally, they can have it on the app. The app is also on a desktop, toolkit.easternunion.com. So it's not just on an app, you have it on a site as well.
Amazing. And I'm just going to put that in the
Shmuel, thanks for the
chat.
shout out on the app is incredible.
Okay. Any other questions here?
Yeah, I had a question I put in the chat, but I think it got skipped over.
Oh, Lila, I didn't see that. Let me look up. Why are local banks still lending with no changes?
I don't know.
That's a good question.
I am not really seeing that. I'm seeing that
We're seeing them very aggressive in Ohio and anxious to do deals, and just, you've got something, bring it. We will lend on it. And we were kind of surprised because we heard about the changes with Freddie and the additional reserve requirements, and we're not seeing that at all with local banks. So anyhow, I was just curious.
So I'll tell you why it's great to have that. We have this call, and I think this is really a great example. having a Zoom call with everyone spread out the way it's spread out, because, in different parts of the country, they have a different attitude towards this whole social distancing and people getting sick and not. And everyone has different, from conspiracy theories to, no, this is the real thing. I drove down to Orlando. I wouldn't fly. And one morning we left at 6:30, 15 and a half hours later, a couple of drivers split it out and we drove. We passed into different states. And it's interesting, the rest areas at different states, you see the difference of how people are out and about. So it could be just Fannie Mae has to do policies right now in crisis. This is the policy. When you're corporate America, they make one decision, just like the unemployment checks. They gave it extra $600. They didn't, no questions asked. As time goes on, then even there could be sections like Fannie Mae used to have different underwriting criteria, lending criteria for different parts of the country. So in your case, it could be your local bank. If at the end of the day in your market, they're comfortable with how many people are getting sick and not getting sick and opening up the state already, and they think that the worst is behind us, I'd also lend regular. But if not the case, so if someone's doing it, I guess it's a market by market on a bank level. I don't think it's just a specific bank. I mean, I think if you were going to a bank in your area, it's a national bank, I don't believe they have different policies. It's probably a more local bank for that area and they're getting comfortable.
Yeah, absolutely. And I think, someone mentioned over here about maybe certain, and I agree with you, it's probably different markets because every market, every local bank is going to be different, but maybe certain banks are going to be lending at lower leverages, but they still want to get their, they still want to have their money working for them. So that may be why they're anxious to doing loans. And, less people looking for loans right now. So that may be why those banks are anxious. So IRA, Jorge asked if you maybe just explain the free underwriting app.
The free underwriting, someone says explain the free underwriting they're marketing on the site. So it's very simple and straightforward. When you get in a deal that you might be looking, you get the OM. What is the first thing you do? Obviously, glance with your eyes and that's it. But after that, you say, oh, let me put into an Excel model that I can play with. What's the same Excel model like when if I would send a deal to a bank, what I put together in? So we take that Excel, we take the OM, and we just convert it into, someone manually types it into a Excel model, and we send it back to you. So at least from that point on, you have the underwriting on it in front of you that you can play with from there. And what we're trying to do as a next step with the app is that fill out the calculator as well. So when you get it and say, what if, oh, my split with this investor be like this, how would that look? And you can say, oh, it looks great for the financing, but based on the splits, it wouldn't work out, and you move on to the next deal. And on the app, you could save property by property with its documents and its own calculator eventually. Now it's just a calculator, general calculator, where you can save the changes, but eventually be able to take care of all that for you. That's
great. That's great. Yeah, I mean, there are a lot of different folks, different groups. I know like different syndication groups and stuff like that have their own kind of modeled calculators, Excel models, but it's a great resource. Absolutely. So, yes, yeah, thank you. What else is going on, guys? What else are you guys seeing in the market? What are the questions you have? Anyone doing deals and they're having to deal with banks right now? Seeing anything special in particular they want to ask IRA?
not all at once. I train people. One of the first things I tell people is that when I start off the process, I tell people, I said, if you remember in school, the teacher's about to end the class and he says, any questions? And you hope no one asks. And when someone asks, oh my gosh, I gotta leave. I told you the only way, I learned the business by asking questions, and you have to look around on this call. When you have to pay your bill this month, the only one person that's gonna be here to help you is you. No one's gonna remember you on this by asking a question if you're stupid. I said, no stupid question. It's not the cliche of only the stupid one's one not asked. Be selfish. If you think there's something that can be helped, ask the question. Stupid question, what do you care? If you move on. I look back at all the questions people thought I asked was stupid. In certain areas, I realized that's not for me. I went to a different direction, and I try to find success where I can find it. So we have a few more questions that came in. The app does not include construction costs, and there's no intention to do that because that's too granular, too specific. I want to be more on the higher end of it. Interesting on the app on the refi, this is something which was a big percent of the cost. The app will be able to, when it's totally done, you'll be able to talk about a capital event. So I have a 10-year projection. if my rent's increasing. But what if I refi year number 4 at these terms? We'll have that built into the app. That's going to have it. It should be on, it might even be one of the versions, but it's going to get there also.
Awesome.
And
Yeah, another question. Someone sent me privately. They probably meant to send it to everyone, but the question is, what are the real estate brokers saying right now? Is it gloom and doom? What are the?
So the real estate sales brokers, or I'm a mortgage broker, they, for the most part, they're saying doom and gloom. But that's the fact that everyone's thinking notes are coming, it means doom and gloom.
Right.
Because if it's going down, so it must be buying. So that's why I like a interesting take about, like, it can't be, if you think that you're going to get deals at a 10, 15, 20% discount, that means the guy's equity's gone. That means the guy's wiped out. So everyone that says, oh, I have money invested, you're up the creek. I met a big landlord today on thousands of units. Sorry, made one decision. We're liquid. We're not putting good money after bad. We're not investing a nickel in 10 deals. If it could carry, great. The day it can't carry, we're stopping. No construction, no fix over. So it's an interesting, interesting time. And like no one knows, this thing could really go for a long time. I mean, some people think it's going to go on for a year, and like someone said, every week people stay unemployed. It's tough to bring them back. I survived in my company this long without these 20 people. You think I need to bring them back? And whoever's working now, no one's giving their boss an attitude today. Everyone's working as a worker, is doing the best that they possibly can to make things work. If you go down the questions here, a little offbeat question. Any idea how buyers are viewing the value of amenities in multifamily? No, I actually did not hear about that at all, because some of the the social distancing spaces don't really play a role anymore. If you're familiar with Argus, here brokers using it. I was curious if other people in the industry utilize it as well. So the answer to Argus is as follows. Yes, everyone uses it at the higher level. So when you're actually modeling a deal down the details, you potentially an Argus run, even though people came with Excel and now with the app. My goal was that for 95% of the back of the envelope you need, the app could do for you. But when you're actually going to buy something that's complicated and commercial, you're typically going to need it for commercial, like office, shopping, retail. That's what you need it for in a big way. Multifamily is not as much. How long do you allow for the loan process these days? I would say if it's a bank deal, probably the same 45, 60 days. If it's an agency deal, you could get it down to 30.
Very good. And just as an off plug there, Argus, one of the things Madison does, our company is Argus runs, of the many services Madison does. So yeah, let's. I think this has been great. I think we've all learned a lot today. We've heard some really inside information in the lending industry, in the mortgage industry, which is not necessarily being talked about. But I want you to take a minute, plug the app over there. But I think it's probably worthwhile to plug the new the breaking news that just happened yesterday with your multifamily group. I'm going to take a minute.
So I'll talk about that. So basically it's there's always the big debate, and obviously, there have been many people in the industry bothered. I have some brokers in my office are thinking about maybe leaving because of it. It's an open discussion. It's like someone having a store and not having an online presence. And people say, you're crazy, you got to have an online presence. The world is changing. So as we're watching the business, there's all different types of people. Some people like to go direct. Some people only like to use a broker. Some people like to use a hybrid. Some people create a competition. There's different strokes for different folks. You can't change them. And at the end of the day, everyone wants to do business differently. Some people believe, would you rather, if you had a choice to own a fast food chain or to own a high-end, top 10 Zagat rated restaurant in the United States, which one would you rather? Some people, they make the same money. I just like the fact that always customers, always activity, that's what I want. And other people say, no, I want to tell my friends I own this restaurant, they can get to the front of the line. It's a personality thing. Tell me by big build, class A, B, C, big, small, there's no right or wrong answer. So all that we did with this whole situation are two of my brokers in the office who've been in the business for, one has been there 19 years, one has been there for 15 or 16 years. They said they do a few hundred deals a year. They find themselves working very hard on structured deals, getting it done. And they work a lot of multifamily, agencies, everything under the sun. Today, the main player in town is agency. And they made a decision. So it's not an Eastern Union policy. They're brokers in my office, boutique brokers, they're still going to charge the regular fees. They decided to bring up volume, let them go ahead and lower their fee on just agency refis to a quarter of a point. So let me have a niche product. It's, in their opinion, it's the relatively easiest. There's less negotiation on those transactions. You're not finding 20 banks to compete. It's the same agencies, a couple of shops, and narrowing it down. And they said, let me try to go of a quarter of a point. And I think that at a quarter of a point, their belief and why people ask why I allow them to do it is that there's many people that are not, that they aren't offended they should use the broker. 60%, as I'm told, on agency have relationships that don't use a broker. But I know when I speak to a lot of them, they say, hey, the broker brings value, but a full point, that's pretty high. And maybe the idea is, could they get some of that market that's not being tapped by brokers? Could they get that market? And that's what it is. Oh, there are always going to be price-conscious people out there. There's always going to be. But that's the idea. So they're using it as a, look, on this phone call, it became enough of a question and a topic, became a conversation piece. And then, hey, I don't have that deal, but I have another deal. So they get business that way. They use that as a, not as a loss leader because they're not losing the money at that price. They have already a team in place, they have the overhead in place, is covered, it's revenue. And they actually think that there's a chance this thing can really take off in a very big way. They're going out now and they're hiring a team of 50 summer interns, commission only, throughout the country, to focus on calling up owners over the summer and say, hey, we're a top 2 brokers at Eastern. We're going to do your deals, multifamily, quarter point. Everything else, they're regular points. They do construction, bridge, financing, notes, everything under the sun. But when you want them to run your agency deal, they'll do that refi at just a quarter of a point. So they just launched it. A lot of different feedback and comments. Most people don't really understand. They thought it's like a gimmick sales pitch for starting. These brokers are committed. They're all in. They have a business plan to take this and make this as a staple to their business. They think the industries are changing. Technology is streamlining. The nature of how things get financed in 3 to 5 years from now are going to change. They want to be the head of the curve as that market curves, as the road curves to where this is headed.
Yeah, excellent. One more question here, and I think we're going to break after that to the breakout rooms, do a little networking amongst ourselves. But we had one more question here from Mr. Edelstein: is when do you go to a bank, and when do you go to agency loan? Good question.
Okay, so the answer is well, in today's day and age, like certain things are easy, depending what you need. Someone wants 10-year fixed. Typically, 10-year money is the cheapest at agency. Someone wants interest only. So there's certain things people want. Agency for multifamily, most people are going to want. Today's is really the predominant place. So it's usually listen to the client's needs, what flexibility do they need, and then we take it from there. So it's trusted advisor first. So we're not going to be in a situation where we're going to steer somebody to an agency who's getting a lower fee or to a bank who's getting a higher fee and it's easier or harder. That's not going to be the drive. It's more we take a deal in, we listen to what your business plan is, and we start with the equity. What's your split with your investors? What's more important to you? A lower rate, higher proceeds, and we run through the app and say, you know something, you didn't realize that if you would take less money to structure your investors from a bank, I could bring you to a regular bank with this terms, and the splits work better for you. Some people didn't realize that because they're trained most money, lowest rates. So I said, no, let's start with 100% of the capital stack. Who are you getting that other equity from? Maybe your equity is too expensive. And then even though my rate is higher to go to 85% leverage with a bridge loan, you're better off because it's cheaper than your equity. So just like we start with that, then we see based on that what's available. I would say for larger deals, it's also easier at Fannie Mae, but I would say for deals in the single-digit millions, many times if the person wants a 5-year loan or less, many times it's shopped between an agency and a regular bank deal.
Excellent. And then is it based on the size of the loan? Is the last question there.
So it's not really based, just like, as a loan gets larger, there are less lenders that could lend per asset larger. So right. Fannie Mae is definitely there for those $100+ million deals, and they'll do deals for $1 million. I think 800. I think 750 is the smallest loan actually, something like that, maybe 500, something along those lines.
Okay, excellent. Yeah, absolutely. So let's get into breakout rooms. I'd love to get everyone on here to do a little networking. And Ira, thank you so much for coming on and adding so much value here. If you could put your contact information in, if you want to, in the chat box.
Do you want to send? You have an email for the people here. You want to send them? You can send my email with my cell phone as well. You want us to put it out there?
So I'll just whatever you want. If you'd rather
I'll put it here. I think you can send an email so people have it. Once we close out, they don't see this anymore.
Right, it's true. Okay, so I can do that. If you register for this, I have your email, but you got Ira's email right there in the chat box if anyone wants it. And
thank you all. I appreciate the opportunity. I hope it was beneficial. I respond to I'm a little behind now because there's a road trip here this week, but I'll be caught up over the weekend, and I respond to every email. So thank you all very much. I appreciate the opportunity. And Yona, thank you so much.
Yeah, pleasure. Thank you so much, Ira. It's really been a pleasure. And everyone else here, thank you. Before we get off, if you guys want to turn your cameras, I'd like to do a little screenshot. So everyone give their best smile. And I only have half the people, so I might have to do it twice because the way Zoom is set up, you only get to do like 30 people on one. So we're gonna get a big smile, and then we'll do it again on the second page. So, okay, there you go. That was good. That was great. I'm glad you guys are actually here with us today. Here we go. And the second one, I'm gonna move to the second page here. And then we're going to the second page. You guys on the second page also get a screenshot. Okay. Got about 50 people here tonight, so that's great. Say cheese. Okay. One was very serious in that picture. To do it again. There you go. All righty, thank you guys. Okay, so what I'm going to do now, this breakout room thing is really cool. If you were on the last time, you know it. If you weren't, it's gonna be pretty fun. We're gonna do it a couple times, I think. And what I'm gonna do is just split the group up into. I have about 36 people left on the call. We're gonna just split up into about 10 or 11 different rooms. So we'll get into groups of 3 or 4, and then just go ahead, introduce yourselves. And at this point, I'd love for you guys to ask one another, what is something that you are looking for right now? Like, what are you looking? What are you? Whether it's a deal, you're looking for a certain type of thing, you're looking for a client, whatever it is, and maybe someone else in that room can help you, or maybe they know someone. And so introduce yourselves. And I did something earlier today on a different call. It wasn't a real estate call, but maybe if you guys want to do it too, I thought it was really cool. We actually had everyone open up another tab. And then those people who they were connected in that Zoom chat, those 3 or 4 people, to open up another tab and find them on LinkedIn, and then connect with them on LinkedIn like that. So you're not just like this person. Who is that person that I spoke to? Someone reached out to me like, I was talking to someone from San Francisco. Do you know who that was? I forgot his name. So yeah, so go ahead and do that. Yeah, so I'm gonna go out and breakout rooms. We got 35 people left. Let's say 12 rooms. So I'll be in groups of 3. Participants. And if anyone wants to jump off at any time, please go ahead and jump off. And thank you guys for coming. This is awesome. And I'm always open. Like I said, I have a huge lineup for the next 8 weeks already scheduled, but I'm open to different subjects and different speakers. So if you guys have something that you want to talk about, or something that maybe you know someone who has a great subject matter that is kind of unique, I want to get a feel for all different types of things in real estate here in this meetup. So looking forward to seeing you guys later. So I'm creating the rooms. You just push the button that says join the breakout room. Okay, bye guys. Fly away, fly away. Now we'll see who's not really here.